Welcome to the debate. Our focus today is Alphabet Inc. That's Google's parent company, of course, a stock that has, well, it's become the epicenter of this extraordinary intellectual divide within the investment community. This split really intensified following their strong Q3 2025 earnings report, and maybe more significantly, the revelation that Berkshire Hathaway initiated a multi-billion-dollar stake.
That Berkshire move is fascinating, yeah, but it certainly hasn't quieted the critics.
Absolutely not. And, that's the central tension we have to address. Does Alphabet's monumental AI-driven capital expenditure, and we're talking tens of billions here, does it justify the premium valuation the market currently affords it? Or does its undeniable failure to meet traditional deep value metrics mean the stock is just priced for perfection with virtually no margin of safety? I'm here to argue that Alphabet is a wonderful company at a fair price. Its superior quality and growth metrics, well, they overwhelmingly justify its valuation, fitting perfectly into a growth at a reasonable price, or GARP, framework.
And I come at it from a very different perspective. I'm going to argue that while Alphabet is certainly a wonderful company, it fundamentally fails traditional defensive deep value screens. The soaring fixed costs associated with this AI arms race, combined with some pretty substantial governance risks, mean that at current prices, well, the stock simply lacks the margin of safety required for a prudent long-term investment. The risk profile has just fundamentally changed for the worse.
Establish the sheer quality of the underlying business, which the Q3 2025 results confirmed, vividly. Alphabet reported its first ever quarter with revenue exceeding $100 billion. That's a powerful 16% year-over-year increase. More impressively, diluted earnings per share growth surged 35% year-over-year. So this isn't some mature company running out of steam. It's a high-growth compounding machine firing on all cylinders. Now, look, I readily acknowledge that Alphabet fails the strict Graham-style PE less than 15 screen. Its PE is currently around 27. When traditional deep value investors look for a defensive multiple of 15 or less, 27 is a huge hurdle.
It's more than just a hurdle. It's a complete non-starter for classic value investing.
But this is where we need to introduce a little bit of nuance. That high PE of 27 is, I think, mathematically justified when you consider its rapid growth. This company passes the crucial growth at a reasonable price, or GARP test. GARP is a philosophy where you pay a little extra for exceptional growth. The key metric here is the PEG ratio, the price to earnings divided by the growth rate. Alphabet's PEG ratio sits at a remarkably low 0.79. A PEG below 1.0 suggests that, relative to its high earnings growth, the stock is actually undervalued. Furthermore, the operational quality is undeniable. Return on equity soared to 30.8% and return on invested capital consistently sits above 20%. These are truly world-class figures that prove management is exceptionally efficient in deploying and generating capital.
That's a compelling argument for quality, I'll grant you that. But I just don't buy that the market price is rational simply because the growth rate is currently high. Growth is fleeting. Price is eternal. Let me tell you why traditional metrics must still hold sway. If we stick to fundamental, time-tested, deep value standards, Alphabet fails almost every classic test. We've established the failure on PE, but consider the price-to-book ratio, which is currently 8.70. This means you are paying nearly 9 times the liquidation value of the business, dramatically exceeding the defensive standard limit of 1.5. This removes almost all statistical safety. But perhaps the most damning failure for a value investor concerned with true long-term earning power is the owner's earnings yield. Owner's earnings, for those unfamiliar, is essentially net income plus depreciation minus the capital expenditures needed to maintain the business.
It's a measure of the cash flow truly available to owners. Alphabet's OE yield is only 4.0% against a desired deep value minimum of 10%. We are simply not being compensated for the operational risks with a sufficient yield, and those risks are growing because the company is fundamentally transforming. Management has forecast full-year 2025 capital expenditure to be a staggering $91 to $93 billion to fund this AI infrastructure race. That dramatically increases operational leverage and thus the risk exposure during any future economic slowdown.
I see the mathematical failures you're pointing out against traditional screens. However, I think we are fundamentally mislabeling this capital outlay. That $91 billion plus in CapEx is not reckless spending. It is necessary growth CapEx. And we have definitive quantitative proof that this spending is de-risked. We need to look at Google Cloud's remaining performance obligation, or RPO.
Okay, define that for us.
Certainly. The RPO is, well, it's essentially their contractual backlog. It represents contractually obligated future revenue that customers have already committed to spending on cloud services. That backlog has surged to a whopping $155 billion. So they are not guessing where future AI demand will be. They are building pre-sold infrastructure to service demand that they currently cannot even meet. The CapEx is high-return deployment of capital designed to build the next competitive moat in enterprise AI. And crucially, it is substantially de-risked by signed customer contracts. This is a definition of deploying capital efficiently to compound value.
Okay, the RPO number is impressive, I'll grant you that. It definitely dampens the short-term speculative risk of the spending. They have customers lined up today. However, you're focusing only on the short-term demand. We have to focus on the structural, permanent change this CapEx imposes on the company's cost structure. This massive CapEx introduces a permanently higher, riskier fixed cost base. We can quantify this risk directly by looking at the ratio of depreciation to gross profit over the trailing 12 months, the TTM data. Depreciation measures the non-cash cost of their fixed assets, data centers, servers, wearing out. This ratio has spiked to 19.8% in the most recent data, up dramatically from its historical average of around 11.2%. This signals a massive, non-discretionary fixed cost is now baked into the income statement. While the $155 billion backlog is being worked through, things look great. But what happens when those contracts are fulfilled, or if macroeconomic conditions tighten globally? That new higher fixed cost base means margins will contract far more sharply and violently than they have in the past. This is precisely why smart investors are warning that this AI CapEx race risks becoming a tremendous amount of capital destruction if returns on that capital don't dramatically exceed the cost.
But that calculation assumes those assets are simply maintenance, destined only to wear out. They are not. They are the core infrastructure fueling the next generation of high-margin services, giving Google the scale advantage in AI deployment globally. Let's talk about the valuation metrics that actually matter for a compounding business, rather than those designed purely for cyclical, low-growth enterprises.
Hold on, price always matters. I challenge your reliance on the PEG ratio, because it inherently relies on high growth rates continuing forever. Traditional defensive metrics cannot be ignored for a true value investment. Let's look at the intrinsic value today. Our conservative discounted cash flow analysis, which assumes FCF growth only at 4.7%, and we use that floor because it's the minimum sustained FCF growth rate they've maintained over the last decade, ignoring the current AI hype, that still places the intrinsic value at $244.84 per share. At the current market price near $278, the stock is already slightly overvalued by this conservative floor, let alone offering the necessary 30% margin of safety that value investors typically demand. When a company fails the necessary owner's earnings yield test, offering only 4.0%, you are primarily buying future expectation and narrative, not present value or statistical protection.
I'm not convinced by that line of reasoning, because using a deeply conservative DCF that assumes a company currently growing EPS at 35% will suddenly decelerate to a permanent 4.7% cash flow growth is, well, it's structurally improbable given the secular tailwinds of digital advertising and cloud adoption. The 4.7% rate is an artifact of the past, not a predictor of the future for a business dominating the global information architecture. This is precisely why the market validates the GARP framework. The PEG of 0.79 suggests that relative to its achievable growth, it is undervalued. Look at a more realistic DCF, the nominal growth DCF. This assumes a very achievable 10% growth for 10 years, followed by a 3% terminal rate. That projection yields an intrinsic value of $451.24, implying a significant 62% upside at current prices.
That's a wonderful dream scenario, but it hinges entirely on their ability to execute that massive CapEx program and maintain margins.
And this is where the non-price margin of safety comes in. We're discussing a company with a fortress balance sheet. The debt-to-equity ratio is a minuscule 0.11, and they sit on $98.5 billion in cash. This is a non-price structural defense that acts as a profound safeguard against the increased operational leverage you correctly identify. This balance sheet safety, combined with world-class net margins of 28.2%, provides a structural moat that traditional PE multiples, designed for capital-intensive, cyclical companies, simply fail to capture. The Berkshire Hathaway purchase, in my view, is a tacit validation of this exact approach, paying a fair price for unparalleled quality, security, and compounding power.
The balance sheet safety is indeed their primary redeeming quality, but it brings us straight back to governance. That cash fortress and that debt-free balance sheet enable the founders to pursue this high capex, high-risk vision entirely insulated from activist pressure. The ultimate safeguard for minority shareholders is their voice, and Alphabet's dual-class share structure removes that voice entirely. Co-founders Larry Page and Sergey Brin retain 51% of the voting power. This governance failure is critical precisely because it means management can commit to that massive $91 billion capex without meaningful external check or opposition from the public shareholders. We saw this reality demonstrated in the 2025 proxy vote, where proposals for equal shareholder voting were overwhelmingly defeated, receiving only 3.8 billion votes in favor versus 8.6 billion against, all due to the founders' voting bloc. The lack of control is a major risk when management is deploying capital at this scale.
I agree the structure limits minority shareholder control, but I would frame the dual-class structure as a strategic feature that allows for necessary long-term strategic planning, unburdened by the short-term tyranny of quarterly earnings. This stability ultimately benefits all shareholders. The founders' economic interests are profoundly aligned with ours. They own approximately 12% of the equity, valued around $170 billion. They are not fleeting executives. They are owner-operators whose wealth is entirely tied to the company's long-term success. The recent commitment to a substantial $70 billion annual buyback program and the initiation of a dividend demonstrates a strong, unambiguous commitment to returning economic value even without formal shareholder pressure. The market isn't ignoring the risk. It's betting on the jockeys, that their long-term vision will continue to compound the pie effectively. So, wrapping up my argument, Alphabet's phenomenal profitability, its robust growth, successful capital allocation, evidenced by that $155 billion RPO, and its fortress-like balance sheet all confirm it is a high-quality compounder. The high valuation, trading at a PEG ratio below 1.0, is a reflection of this durable quality and exceptional growth trajectory, not a flaw. The non-price margin of safety is what truly protects this investment.
And to summarize my view, while the underlying business quality is undeniable, the current price offers no statistical margin of safety based on traditional defensive value tests like PE or the owner's earnings yield. The dramatic rise in the fixed cost base due to aggressive capex, combined with the structural lack of public shareholder governance, represents significant structural risks that are just not compensated for by a sufficient discount in the stock price. It remains a wonderful company, but unfortunately it is priced for flawless execution, offering no buffer for investor error or macro surprise.
Our analysis, therefore, really underscores the complexity of evaluating a unique financial powerhouse like Alphabet. It forces every investor to choose which framework to prioritize.
Indeed. An investor's assessment depends entirely on whether they prioritize statistical undervaluation and safety measures designed to prevent losses or durable quality and sustained compounding growth prospects. The material presents compelling evidence that supports both sides of this enduring investment debate, confirming that true clarity often requires a rigorous challenge to core assumptions.